Good day everyone. We are from the group called We Break Together. Today we will be presenting the detail of financial analysis for three companies: Axis Sendirian Berhad, financial ratio analysis over past 2 years, Haloba Berhad, financial planning and forecasting. The third one will be Toyoma Berhad, cash flow analysis and liquidity management. Our goal is to evaluate financial performance, identify the challenges, and provide strategic recommendation to improve financial stability. Let's begin with the first question. The first question will be financial analysis for Axis Sendirian Berhad. Axis Sendirian Berhad, over the last 2 years, we will access their financial indicators. 1. Profitability ratios, how efficient the company and generates the profits. Efficiency ratio, how well it utilizes its assets and generate revenue. Third will be liquidated ratio, whatever it is enough for the shortcoming or the short-term liabilities. Debtor turnover, how quick they pay over to the debtors or receivability. Market confidence, how the investors are going to invest into Axis Sendirian Berhad. Okay, at the end of the section, we also will highlight the key challenges and areas required to improve for Axis. Further to that, we will analyze the profitability analysis on the company, how healthy they are on their financial matters. Profit operating margins has dropped from 14% to 7%, meaning the company is making a loss per dollar values, which could be higher than the operating costs. Increase of raw materials, as we know worldwide we are having an increase on raw materials, and also or lowering the pricing strategy. So there's a few key consideration that we have to do here: higher operating costs, increase of margin, raw materials, or lowering the price of the requirement. RECO has fallen from 35.2% to 20%, indicating the company has not generating too much of profit from the capital investment before. So declining of the profit could make Axis lesser attractive for investors and reduce financial flexibility on future expansion. Cost control and efficiency should be improved here or needed, because it makes very less attractive for investors to come in and invest. That's where we have profitability analysis. Further to that, we will speak on efficiency analysis. Efficiency analysis is also the asset turnaround, how much Axis is generating. Actually, in this case, when we analyze and see, Axis is actually generating more revenue from the asset. However, this has not translated into higher profitability. It suggests that the sales should be increased, so the company may be focusing for lower margin products, facing higher operational costs, or eating up into the profits. Maximizing profitability, Axis should balance up their sales growth, also cost of efficient and pricing strategy.
Hi, I'm Tan Airi. I'm going to share liquidity analysis. Liquidity measure whether a company has enough short-term asset to cover liabilities. The current ratio dropped to 1, means subsidiary barely has enough asset to cover short-term debts. The asset test ratio declined to 0.6, indicators that much of subsidiaries' assets are tied up in inventory, which cannot be quickly converted into the cash. This could lead to cash flow problem, making it harder to pay supplier and creditor on time. Next, debt turnover analysis. Subsidiary is taking longer to collect payment from customer. It's from 20 days to 50 days. Slower collection will reduce cash flow, making it harder to cover operating expenses. This delay could be due to looser credit policy and inefficient collection process. Subsidiary should tighten its credit term and improve collection to avoid financial strain. Come to investment and market analysis. Despite 33% revenue growth, profits has declined and the share price has dropped. This suggests that raising revenue is not translating into higher profitability, which is concerned by investors. The company needs to stabilize costs and improve margin to regain investor confidence. Recommendation for successors and Berhad. Addressing to this challenge, successors should implement cost-cutting strategy to improve profit margin. Second, strengthen liquidity management by improving collection and maintaining cash reserve. Last, rebuild investor confidence by improving profitability and financial transparency. By focusing on this area, successors can enhance financial stability and attract more investors. Thank you. Next, debt turnover analysis. Successor is taking longer to collect payment from customer. It's from 20 days to 50 days. Slower collection will reduce cash flow, making it harder to cover operating expenses. This delay could be due to looser credit policy and inefficient collection process. Successor should tighten its credit term and improve collection to avoid financial strain. Come to investment and market analysis. Despite 33% revenue growth, profits has declined and the share price has dropped. This suggests that raising revenue is not translating into higher profitability, which is concerned by investors. The company needs to stabilize costs and improve margin to regain investor confidence. Recommendation for successors and Berhad. Addressing to this challenge, successors should implement cost-cutting strategy to improve profit margin. Second, strengthen liquidity management by improving collection and maintaining cash reserve. Last, rebuild investor confidence by improving profitability and financial transparency. By focusing on this area, successors can enhance financial stability and attract more investors. Thank you.
Hi, I'm Satyavati Somia and I will be sharing on the financial impact of projected 20% sales increase on Haloba Berhad's balance sheet planning. Haloba Berhad is a medium-sized manufacturing company. It is operating at 80% of capacity, meaning it has some room to increase production without major investment. It is planning to increase sales promotion, which is expected to increase revenue by 20%. Currently, sales are fully by credit sales. Now, 50% of new sales are expected as cash transactions. There are no major operational changes planned except for resource acquisition to support sales growth. The company will borrow additional funds if extra cash is needed. Okay, I'll be sharing the assumptions how the 20% increase in sales will impact specific balance sheet items. Okay, the first is cash. Okay, cash increase less than 20%. Since 50% of new sales in cash, there is a sudden increase in cash flow. However, some cash will be used to purchase additional resources to support the sales growth. Okay, accounts receivable refers to the money that a company is owed by its customer for the goods delivered but not yet paid for. Okay, therefore, you can see there is an increase but less than 20%. Why? Because 50% of new sales are cash, thus reducing credit sales growth. Okay, next, inventory. We can see inventory increases proportionately by 20%. Why? Because more raw materials are needed to support sales growth due to higher demand. Next, accounts payable. Accounts payable also increases proportionately by 20%. Okay, it refers to the money that a company owes to its supplier for its good. So here, higher purchases will lead to increased payables. Next is accruals or wages payable. Okay, it also increases but less than 20%. Okay, since no operational changes are planned apart from acquiring additional resources, existing employees may handle the extra production with same overtime. Okay, followed by gross fixed assets. Okay, that might be no change or slightly increase. The company is operating at 80% capacity, meaning it can accommodate the 20% of sales increase without significant capital investment in fixed assets. However, minor expenditures on maintenance or equipment upgrades may be needed. Okay, accumulated depreciation might be a slight increase. Depreciation is based on existing fixed assets, so it will continue to accumulate at a historical rate. If minor new investments are made in fixed assets, depreciation may increase slightly. Debt increase if additional funding is required. If internal cash flow is insufficient to fund increased working capital, borrowing may be required. The debt level will rise depending on the cash shortfall. Next, equity. Equity, we don't see any immediate change. Since the company is only increasing sales and not issuing new shares, equity remain unchanged in short term, unless profits from increased sales lead to higher retained earnings over time. In conclusion, with Haloba Berhad's 20% sales growth, we can see inventory and account payable will increase proportionately. Cash, accounts receivable and wages payable will increase but less than 20%. Gross fixed assets, accumulated depreciation and equity remain mostly unchanged. Debt may increase if extra funding is needed to support the growth. Thank you.
Hi, I'm Lawai Singh. I'm presenting the cash flow analysis for Toyoma Berhad. Peak season passed, sales forecast adjusted. 40% are cash sales and 60% are credit sales. Cash budgeting required to maintain liquidity. Toyoma Berhad must carefully manage cash flow for the post-peak season. Strong cash position due to the peak season sales, cash inflow are sufficient to cover all the expenses, but inventory and supply payment need carefully planning. Optimizing cash flow ensure financial stability during off-peak months. According to the chart, the key cash flow calculation, total cash inflow in September is 38,000. Purchase in October is 21,000. Total cash disbursement in October is 30,950. Cash balance in end of the November is 39,150. Thank you.
I'm Sogeki for conclusion and key takeaway. In conclusion, this analysis highlight key takeaway for these three companies. First, for Dexisys Sdn Bhd, it needs better cost and liquidity management because despite its revenue growth, profitability, liquidity, and investor confidence has declined. The company needs to focus on cost control, cash flow management, and financial transparency. Number 2, why Haloba Berhad led its increase in 20% in sales? Projected 20% sales increase, different balance sheet items will be affected, varying proportions. There is a proportionate increase in the inventory and account payable, less than proportionate increase in cash, account receivable, accrued receivable, and accrued wages. Minimal or no change in gross fixed assets, accumulated depreciation, and equity possible increase debt. This assumption that help to ensure the company maintains a stable financial position while managing the acceptance growth efficiently. Lastly, for Toyoma Berhad, it must optimize cash flow to maintain financial stability. After the peak season, Toyoma needs to manage cash flow carefully by ensuring efficient credit collections, controlling inventory, and optimize payments. Overall, all three companies must implement proactive financial strategies to ensure long-term sustainability and growth. This concludes our presentation. We have covered financial analysis, future projection, and recommendation for Dexisys Sdn Bhd, Haloba Berhad, and Toyoma Berhad. That's all from us. Thank you.